Going into covered calls, we're just going to take, let's just take the first position that pops up on a search. I don't even know what default search I have in covered calls. It looks like I'm looking at the weekly picks of the day. Firm had a big move down today. That's not a great example, but let's just go ahead and take, wow, SMCI, good move today. I don't know if that was earnings related, but that's pretty strong there. SMCI has been on a strong run, just like NVIDIA and, of course, AMD. Let's just stick with Carvana, nice $53 stock, up 74 cents today. Now, in our weekly picks of the day and the monthly picks of the day, and tested criteria that Ernie has used, Ernie put together years ago and that we use here for the picks of the day. Now, they're always in the money for the higher downside protection while still looking for a good percent return if assigned. These are not positions that we're planning on holding long-term, Shashir. These are positions that we're using to make a target of a 1.5, 2% return, perhaps on a weekly expiration, depending on volatility and what's going on in the market, with a good downside protection. If we're able to get the midpoint, shouldn't be too hard to get around 420, 422, with a bid of 415 and an ask of 430. What I want to do, though, is link to the option chain. And Carvana is more of a volatile position. I understand that. That's why we're seeing a high return for a weekly position. And what I meant by how you trade covered calls, your second question was, how should covered call candidates be chosen if the sell warning is there? Well, I'd say right now, with the light pink warning, we're going to check that in a minute to see if it changed for February 9th. You still want to use the same criteria that you've always used. You're looking for good bullish stocks. You're looking for stocks in an uptrend. The one thing that you might want to consider changing, whether you're weekly or monthly, is if you're normally just going at the money to slightly in the money, if you feel that we're slightly in the sell warning or bearish sell, which has been very useful to me for timing market movements and making adjustments on my positions, planning for a potential slight correction or pullback, or looking to load up and buy into other positions, open new calendar spreads, new bull puts with confidence, but I typically always have confidence in the bull put settings. But open new married puts, I'm looking to do a few of those too, even though the sell warnings are appearing. But for the covered call position, we know the downside. Your hedge is only the premium you collected, the moneyness from the premium, and the time value from the option that you sold. So if you're typically just right at or just slightly in the money, you might want to consider, whether you're weekly or monthly, going deeper in the money in those cases to get the higher downside protection. The downside protection is how far the stock can drop before you're technically losing money on the position. This weekly strike we were looking at, the 50 strike for next week, our Carvana trading at 53.13, premium of 422. That would give us a net debit of about 45.76, 45.80 or so, excuse me. Meaning the stock could drop to 45.80 before we're technically losing money on the position, or 8% of the current price at 53.13. Downside protection is essentially a percent to break even. And if the stock stays above 50, we'll get assigned to make that 2.2%. There's about a 67.6% chance. And I'd still be happy with the weekly return if I was able to get the midpoint here, going maybe even down to the 48 strike with almost an 11% downside protection and 1.4% return if assigned. I'm not advocating or suggesting, recommending a covered call position on Carvana at this time. We're just evaluating the comparison of in the money to out of the money. But again, why would I be trading in the money covered calls to begin with, Shashir? The better downside protection, still a reasonable return, whether weekly or monthly. But I'm not married to this position. I'm not looking to hold it long term. It's not a long-term holding in my account. If you have shares, bulk shares, let's say, of Apple, Microsoft, things that you've owned for years, when Apple or Microsoft was down in the $100 level, I had a coaching session the other day with a gentleman who has 6,000, I think 6,200 shares, I believe, of Apple, and he's lowered his cost basis over the years to something like 67 or 76. I can't remember. Getting dyslexic in my head. I can't remember the numbers there. What he said. but he's just been trading it for years and years and years and doing covered calls and doing other strategies. He doesn't want to sell in the money covered calls on that Apple position. He's holding it forever as long as he can. He's typically selling out of the money calls. He wants to collect an extra dividend-like income on a monthly or weekly basis. Yes, the Apple premiums are much different percentage-wise here than Carvana due to the implied volatility of Carvana versus Apple. But again, the idea is he doesn't want to be assigned on those positions. He doesn't want to lose those shares. Maybe he could lose 200, 300, 400, but he's going to have a very high tax, adjustment when that comes out on the positions he gets assigned on. I'm assuming he's in an IRA. I didn't ask him, but that's what he's doing. So now here comes the dilemma, Shashir. If you're doing this approach on stocks that you're holding long term and you're selling out of the money positions that you don't want to be assigned, and you're concerned that the market's overbought, you're starting to see the sell warnings, and maybe we get to the bearish sell warnings today, Monday or Tuesday, and that triggers that 2 or 3 idea. We're going to look to maybe adjust our bullish positions or add extra protection. In this case, rather than going to a lower strike where you may risk being assigned, if the movement we're expecting doesn't happen in that shorter time frame, that's when you'd consider maybe buying puts directly on the stock to create a collar position, or you might consider buying broad-based puts, SPX, VIX calls, for example, QQQ, in the case of Apple maybe, because you want to hedge that portion of the drop, but you don't want to move the strike too much lower because you don't want to risk getting assigned if the movement you're expecting, the bearish movement you're expecting, doesn't happen during that shorter term time frame. Let's just take Apple now with a lower implied volatility for sort of a portion of your next question. So far, we've talked about the market sentiment tool. We talked about the covered calls and what you might look for if you're expecting a bearish move. If you're doing in-the-money covered calls, you might take a chance of going slightly more in the money for better downside protection. If you're selling at or out of the money covered calls for positions you don't necessarily want to be assigned, you're just trying to collect a dividend-like income on a weekly or monthly basis, then that's when you might want to consider adding a put to create a collar position, buying a put option, maybe with the same expiration as your call. Try to find a lower price, but still a reasonable hedge. If Carvana's at 53 and I've sold the, let's say, I apologize, folks, I sold the 57 strike for $1.05, I don't want to buy something like a 35 or a 30 strike put on a Carvana because it's only 20 cents. But I also don't want to buy a 48 or 49 if it's trading at $2 or $2.10. So I don't want to negate all of the positive premium I collected. The put would have to make sense, and I'd use the custom spread tool to evaluate which puts might work better. Or again, just puts on broad-based ETFs or calls on the VIX if you're anticipating a downturn. Now, are monthly better than weekly? A couple of years ago, or no, it was a couple of years ago. It was back in 2022. A gentleman during the webinar, if I'm not mistaken, had asked, well, in a market downturn, in a choppy market like we were seeing in 2022, is it better to use monthly or weekly? And we sort of did if I'm not mistaken, we did about a 3-month back test using Apple or a common stock. And we looked at what the return would have been if we just sold week by week by week during those fluctuation times versus selling, and they were in the money, if I'm not mistaken, selling in the money calls that were 1 month out in time. And the 1 month out in time position gave us higher premium, naturally, higher time value. It's not 3 times the cost of the weekly. Let's just take the at the money. 7 days to go to our February 16th expiration. The 187.50, let's call it 270. 35 days out, 5 times the amount of time. Standard March expiration is the 187.50. Well, it's not even available. I'm sorry, let's use the 190. It's at 137. Would we expect this to be $6.15, for example? No. It's going to be $4.05. But with an in-the-money call here, it was with 1098 at the 180 strike, let's say, versus 920, I'm really not getting that much more because it's deep in the money. We're about 8 points in the money. We're getting a little bit more. but I have almost a 6% downside protection as opposed to the weekly. Okay, it's still 5%. But what we saw in that test is that the weeklies weren't giving as much hedge. Maybe we were, I think we did look at the money. I do apologize. I think we were looking at the money here. So we only had a $1.37 hedge, or 0.7%. So in 1 week, the stock fell 3%. We were at a loss of about 2.3. Moved the call down to the at-the-money strike. It suddenly reverted back up, got assigned, but we were assigned at a small loss because you only made 0.7% back after a 2.3 loss in the holding, and so on and so forth. Whereas the at-the-money strike here, in the first week, you were still at about break even. The second week, it was looking like a positive trade. The third week, it was just a little bit below the strike price. And the fourth week, it still got assigned for that 2.83% return. In a choppy market, in a volatile market, and expectations of a downturn, in my opinion, it might be more safe to go with the monthly option. Are you lowering your potential annualized return by shifting from a weekly series to a monthly? Yes. But at the same time, you're giving yourself a little bit more boost of downside protection while still achieving a regular potential return for that time frame. Also, one thing I found with the weekly, unless you have a trading plan in mind and unless you're using the Power Options portfolio tools to track and manage your positions and set alerts, in my opinion, using the weekly in a volatile market, we're expecting a downturn, we are going to see a pullback that you may be expecting, and then you're going to see a push up when buyers start coming in, then you're going to see another pullback. You're overthinking it, and you're constantly, potentially, I should say, over managing the weekly position. You're rolling out to the next week, you're rolling down in strike. Oh, now I got to roll back up because I'm actually at a negative percent if assigned because I was trying to be defensive. Oh, it's kept exceeding my strike. I've got to roll up again, but now I've got to move it out 3 weeks to roll for a credit. Oh, it fell again. Let me bring it back down. If you're expecting a choppy market, if you're expecting a downturn, I think it's a calmer, safer play to maybe consider the monthlies instead of moving to the weeklies. But again, that's an opinion. That's my opinion. You asked the question, are monthly better than weekly? Weeklies are better in a consistent market to get a better annualized return. If you have the time to watch them, and of course you have your trading plan set of when you look to manage or adjust the position. The monthlies are a little bit more calming. You have a little bit more downside protection. You have a better percent to break even. You don't have to react as quickly or as fast to the market movement. And of course, you still have the ability to get a maybe potential higher time decay in your favor because you sold into that. So it makes rolling down or rolling up even potentially a little bit easier because of the extra premium you received in a choppy market, if that is your expectation going forward. Okay, now, last part of your question. If the stock falls after the covered call is open, what are the management options? Well, we sort of discussed them. We're going to take a look a little bit more deeply. And then your follow-up question, that was, when should they be applied for weekly or monthly? And that's why I wanted to be here, because again, Shashir, that depends on which approach you're using. If you're using in the money covered calls because you're not married to the so that's a terror. Let's go with this 0.4% return for a weekly. Vast difference to Carvana, right? 0.4% return, slightly in the money, versus a 2.2% return for next week. Of course, that's the implied volatility. Apple's at 0.1852. Carvana's up at 0.8. So vastly different positions. In any case, this year I'm trading weekly. I'm not married to Apple. I just bought it at 188.85. I sold the 185 call to get a 0.4%, 0.5% return for next week. Because I'm in the money and I've got that almost 80% probability of this being assigned and making that 0.4%, I also get a 2.4% downside protection. 2.4% before I'm technically at break even, the percent to break even. And I'm at the 185 strike. So in this case, I probably wouldn't look to roll down or adjust this position in a defensive pattern unless the stock fell maybe 3 or 4% down into the next strike levels here. Goes down to 181 or maybe 180. I might look to buy back this 185 fairly cheaply, maybe only 60 or 50 cents, and then consider rolling down to maybe the 182.50 or the 180. But again, what did I do? We had the 188.85 and we collected 455, which put my cost basis where? Around 184.35. Now, if the stock's trading at 182, for example, I'm still down 235 on the position. So I want to make sure that these new strike prices I sell that are deeper in the money for protection, because I want it to be assigned eventually, if I sell the 180, it's got to at least give me 435 in time value, because I don't want to risk potentially getting assigned for a loss. I may not be able to roll out to the next week. I may not be able to roll 2 weeks. I might have to go to that March expiration in order to roll to where I'm still profitable. But that's an idea. If I have a 2 or 3% downside protection, I might wait for it to drop a little bit below that to 4 or 5% loss on the stock before I look to adjust the position. Now, if you're in an out of the money position, you sold the 195 here for only 25 cents. It's a 0.1% yield. So you probably would have been at the 192.50 at 0.3%. Let's just stick with that. So some kind of dividend-like return on a weekly basis for that 0.3%, for example. Well, you only have 0.3% of downside protection. So in that case, if the stock fell 1 or 2%, I might consider moving that down. There's no real rule for, 2 times the amount of downside protection you have, 3 times the amount of downside protection you have. It depends, Shashir, on your trading plan. Of course, your trading goals, most importantly, your risk tolerance in those situations. A comment came in. I'm sorry, the comment came in and says, you can use delta as well. Yes, some investors will use delta. So I opened this with a delta out of the money of 0.234. If the stock moves down and my delta moves to 0.1, I might continue to roll down to the next 0.3 delta. That's a common approach. Also used in spread positions, credit spreads or debit spreads, for example, if the position's starting to be threatened. If I'm in the money and I had that delta of 0.810, and the stock falls to that price and it drops maybe by half down to 0.4, it's now out of the money. That's when I may consider rolling to a new 0.6, 0.7 delta. You could do it that way also. Not something that I use, as you can tell, so it's not really a rule of thumb. More or less, I look at it based on my original downside protection and, of course, my percent to break even number. But usually if I'm here at the 185 and it drops below the next strike, it drops down to 182 or 181, that's when I might look to roll down the position, but I still have to make sure it's profitable in that case as well. Percentage-wise, we talked earlier, just a moment ago, about the weekly picks of the day, the general search we were looking for when we saw Carvana. And we also talked about the monthly picks of the day. Well, in those criteria, the weekly picks of the day, when you go to the basic view, you can click on see how we develop these results. And Ernie's discussion here with his testing that he did and the time frame that he used, let me see if I can find it here on this write-up. Okay. For the weekly covered calls, he used a stock price of 10%. But the covered calls that he found that worked best during the testing time frame, as you can see, Affirm, Sunrun, Biosciences, Carvana was on that list when we looked at it. These positions have a little bit more volatility. So the percentage if assigned, even for a weekly, is pretty high. So what is he talking about with the 10%? Well, if these positions here on the weekly have a percent return if assigned of 3%, 2.8, 2.8, Carvana was 2.2 if I'm not mistaken, that 10% is about 3 to 4 times the initial downside protection that was offered. Okay, so that's one way to look at it. Now on the monthlies, he actually used a much deeper stop, looking to close out the positions if the stock fell, I think, closer to 25 or 30%. That's because they're more volatile positions. They're a little bit more extreme. If you're using less volatile positions, again, the strike rule is a pretty good one. You had a 2.5, 3% downside protection. If there is a 4.5, 5% drop, that might be a good time to consider rolling down, taking some profit off the call you sold, and looking for a new call that still gives you a positive percent if assigned if it moves above the strike price.